Stop scrolling. Your retirement account is already inside the biggest financial experiment of our lifetime. And the scary part is this experiment isn't IT happening on a trading floor where you can see it. It's happening inside the plumbing of global settlement, inside the quiet math that holds up the entire U.S. debt machine. January 1st, 2026 was the moment the switch flipped. Not because America collapsed that day, but because the rules of convenience changed. That's what nobody understands. They think collapse is a headline, a crash, a single dramatic moment, but modern collapse is a slope, not a cliff. And the slope gets steeper when the world stops being forced to use your highway. China didn't defeat the dollar on January 1st. They did something more subtle. They made the dollar optional in specific trade corridors. And once the dollar becomes optional, the price of financing, America's debt, starts creeping higher for reasons that have nothing to do with your feelings and everything to do with math. The title says $318 trillion, and I want you to be skeptical. Good, be skeptical. Because if you're not skeptical, you become the kind of investor who panics at the exact wrong time. The $318 trillion number isn't the national debt number politicians repeat. That's around $38 trillion. It's the bigger picture when you stack promises, obligations, future shortfalls, pensions, and long-term commitments into one reality-based number. Not all due tomorrow, but all pulling on the system like gravity. Here's the real thesis of this video. America doesn't have a debt problem. America has a financing problem. Debt is only fatal when it becomes expensive to roll over. And for decades, rolling it over was easy because the world had to hold dollars. The world had to settle in dollars. The world had to clear through the dollar system. So the world naturally held treasuries as the safest liquid storage unit for that system. But now a parallel settlement rail is growing fast, not replacing everything, bypassing the most valuable flows. Energy, commodities, cross-border trade. And those are the flows that created constant global dollar demand for decades. So here's what we're going to do. I'm going to walk you through the mechanism in 5 stages. Stage 1 is the invisible debt. Stage 2 is the rollover trap. Stage 3 is the currency bypass. Stage 4 is the confidence leak. Stage 5 is what you actually do about it without panic selling and destroying your future. And I want you to drop a comment right now. What do you think breaks first over the next decade? U.S. interest costs, political dysfunction, global de-dollarization, technology bypass, like digital currencies, or something else? I read the comments because the smartest people aren't on cable news. They're here. And if you like deep, no-fluff analysis like this, hit the like button at some point during the video. It helps the channel reach more people who want truth instead of noise. Now let's begin with the part that most people never notice until it's already too late. Interest. This is the invisible debt, and it's quietly eating the empire from the inside. Stage 1 is the invisible debt. And invisible debt is deadly because it doesn't feel like a crisis until it becomes the entire story. Interest costs are the silent killer because they rise without giving you anything in return. No new roads, no new hospitals, no new productivity. You just pay more money to keep the past from collapsing. Think about a mortgage. If you owe $500,000 at 3%, you pay one level of interest. If that rate jumps to 6%, your cost explodes even though the loan amount didn't change. That S happening to America, except America. S mortgage is tens of trillions, and it never stops rolling. When rates were near zero, America could borrow almost endlessly, and the interest burden looked manageable. Not healthy, but manageable. Now rates aren't near zero anymore, and every percentage point becomes a massive yearly bill. Here's the key insight. Most people talk about the debt number like it's the problem. The real problem is the speed at which the interest bill grows when rates rise. That's why this becomes irreversible at a certain point, because the system starts borrowing just to pay interest, and then borrowing more because the interest on the interest keeps rising. This is how you get the slow collapse effect. In the beginning, the government can still function. They still pay the bills, they still roll the bonds, they still look normal. And that's the trap, because normal-looking systems are the easiest ones to stay blind inside. Now tie this to January 1st, 2026. Why does China's digital yuan matter to this interest story? Because America's financing advantage was global dollar demand. If foreign demand weakens even slightly, Treasury yields have to rise to attract buyers. Higher yields mean higher interest costs. Higher interest costs mean bigger deficits. Bigger deficits mean more bond issuance. More issuance means the system needs even more buyers at even higher yields. That's the spiral. But I want you to understand this clearly. The digital yuan doesn't need to replace the dollar globally to trigger this spiral. It only needs to chip away at the most important source of structural demand. The automatic buyers, who used to hold dollars and treasuries simply because trade demanded it. When that automatic demand weakens, America must pay more to convince investors to hold the debt. And once America must pay more, the math starts breaking faster than politics can react because politics is slow and math is instant. This is why you keep hearing terms like fiscal dominance and debt trap. At some point, rates can't stay high without breaking the budget, so the central bank gets pressured to suppress yields, which pushes inflation risk, which pushes investors to demand higher yields anyway. That's a confidence tug-of-war, and it rarely ends cleanly. So stage 1 is the interest burden quietly becoming the main character. Stage 2 is where it gets darker, because it's not just about paying interest. It's about rolling over the principal forever, and that is where empires actually get trapped. Stage 2 is the rollover trap, and this is the part almost nobody understands unless they've worked inside bond markets. Governments don't pay off the debt like a normal person pays off a loan. They refinance it constantly. Bonds mature every week, and when they mature, the Treasury issues new bonds to pay the old ones. That means the system only works as long as there's steady demand for new bonds at yields the government can afford. Imagine you're paying off one credit card with another credit card. It works until the bank says your interest rate is going up or your credit limit is shrinking. America's version of the bank is the global market. The market is the jury. The market is the judge. And the market doesn't care about speeches. For decades, the demand was almost automatic. Foreign central banks bought treasuries because they needed dollar reserves for trade. Sovereign funds bought them because they needed liquid safe assets. Pension funds bought them because they needed stability. Banks bought them because they were high-quality collateral. The point is, there was a deep structural bid for treasuries. And that structural bid allowed America to borrow huge amounts at low rates without immediate punishment. Now here's where the bypass changes the game. If some trade can settle outside the dollar rails, then some countries need fewer dollars for reserves. Fewer dollar reserves means fewer treasury purchases over time. Not all at once, not a panic, not a crash. A gentle but relentless reduction. And that gentle reduction matters because rollover is constant. The US doesn't need one buyer one time. It needs buyers every month, every quarter, every year at scale. So the question becomes, if structural foreign demand declines, who replaces it? There are only 3 options. Domestic buyers step up at the same yields, which is not guaranteed because they have their own constraints. The US offers higher yields to attract enough buyers, which raises interest costs and worsens deficits. Or the system monetizes more debt, which raises inflation risk and pushes yields higher anyway because investors demand compensation. That is the trap. You can shift the burden, but you can't escape the math. And this is why a parallel settlement system is so dangerous. It doesn't need to win the whole war. It just needs to reduce forced demand enough that auctions start requiring higher yields to clear consistently. Watch this phrase, auction clearing. It sounds technical, but it's the heartbeat of the system. If auctions start to show weak demand, yields jump. That jump increases interest costs. That increase forces more issuance, and the next auction becomes even harder. And that's how a slow problem becomes a fast problem. Now, stage 3 is the bypass itself, the mechanism that makes this reduction possible. We need to talk about what actually changes when trade settlement becomes cheaper, faster, and independent of dollar rails. Stage 3 is the currency bypass. And this is where most people get confused because they imagine this as ideology. It's not. It's economics. Businesses do what saves them time and money. If a new rail settles faster, costs less, and reduces exchange risk, people adopt it for practical reasons, not political reasons. Old system example. Let's say Thailand buys energy from Saudi Arabia or materials from another major exporter. Under classic dollar settlement, you touch dollars somewhere along that chain. You convert currency into dollars, clear through dollar-based infrastructure, then convert again. Each step has fees. Each step has time delay. Each step has exposure to exchange swings. Each step increases demand for dollars as a temporary bridge currency. Now imagine a settlement rail where you transact directly in local currencies or in a digital WAN corridor. Instant settlement. Lower friction. Less conversion risk. No need to hold big dollar buffers for that specific trade relationship. That's what a bypass does. It doesn't eliminate the dollar globally. It reduces the number of transactions that must touch dollars. And when you reduce those transactions across energy and commodities, you reduce the foundational demand that supported the dollar system for decades. This is why the phrase parallel system matters. If the world had only one highway, everyone had to use it. Now there's a second highway forming, and it's improving every month. Network effects are brutal. Once adoption starts, infrastructure grows. Then adoption accelerates. Then the system becomes self-reinforcing. More merchants accept it. More countries connect. More banks build tools around it. More users normalize it in daily life. And the bypass becomes a default option in more corridors. Now here's the important psychological shift. Once the dollar is optional, the world begins to think differently about reserves. You don't need a giant pile of dollars for safety if your trade can route around the dollar in emergencies. You don't need as many treasuries for settlement liquidity if alternative rails can clear major flows. And that mental shift changes portfolio behavior slowly and then suddenly, because institutions move slowly until they all move together in the same direction. Then the market reprices in a hurry, which brings us to stage 4, the part that turns slow erosion into danger, the confidence leak. This is where the market stops treating treasuries as purely risk-free and starts demanding a premium for fiscal risk. And when that premium begins, it rarely stays small. Stage 4 is the confidence leak, and confidence leaks don't make noise at first. They show up as small changes in yields, small shifts in bid to cover ratios, small soft spots at auctions, small whispers that nobody wants to repeat because it sounds like heresy. Treasuries are supposed to be risk-free, the benchmark, the foundation. But here's the truth. Treasuries are not risk-free. They are default-free in nominal terms because the government can print dollars. But that is not the same thing as being risk-free in real terms. The real risk is purchasing power. The real risk is inflation. The real risk is being paid back in weaker money. Confidence begins leaking when investors suspect that the future will require either higher inflation or financial repression to keep the debt manageable. Financial repression means keeping rates below inflation to slowly reduce the real debt burden. That's great for the borrower. It's brutal for the lender. And when lenders sense that path, they demand higher yields now. Now, watch what happens. The spiral begins. Higher yields increase interest costs. Higher interest costs widen deficits. Wider deficits require more borrowing. More borrowing means more bond supply. More supply forces, yields higher again. This is the debt snowball. And once it starts rolling, it gains mass. The political system cannot move fast enough to fix it because fixing it requires choices no politician wants to campaign on. Raise taxes significantly, cut spending significantly, reform entitlements, freeze benefits, reduce programs, austerity. None of that wins elections. So instead, the system drifts, and drifting works until the market stops accepting the drift. This is what slow collapse means. It's normal until it's not, and there's no countdown clock on the news. The market functions normally right up until the moment liquidity disappears and yields gap higher. Now I want to be clear. This is not a prediction that tomorrow the dollar dies. This is not a call for panic selling. This is a call to understand the regime shift. We are leaving a world where America could borrow almost infinitely at cheap rates because there were no alternatives. We are entering a world where alternatives exist, even if imperfect. And alternatives exist is enough to raise the price of lending to the most indebted nation on earth. So what do you do with this without destroying yourself? The answer is stage 5, positioning without panic, because the worst losses come from being right about direction but wrong about timing. Let's talk about that next. Stage 5 is positioning without panic because the biggest trap in macro investing is turning a long-term truth into a short-term bet and getting crushed before the world catches up. Here are 3 realities you must accept. First, systemic transitions take years, often decades. The shift from the British pound to the US dollar wasn't a weekend event. It was a long, slow transfer of trust, trade, and infrastructure. Second, there's no perfect replacement for the dollar right now. The euro has political fracture risk. The yuan is not fully open in the way global capital wants. Gold is powerful but impractical for high-velocity settlement. Bitcoin is volatile and still politically controversial for many institutions. So the dollar stays best available, even if it becomes less dominant. Third, timing is vicious. You can be correct that debt dynamics will pressure America over time. But if you exit too early, you can miss years of gains in liquidity and stability while the system keeps running. So positioning means diversification, not abandonment. It means you hold dollars because the world still prices in dollars, but you don't hold only dollars as if the last 50 years will repeat perfectly. It means you favor productive assets over purely paper claims. Real businesses that generate cash flow, real infrastructure, real estate in strong areas, productive capacity, resources, farmland, energy exposure through quality vehicles. And yes, strategic precious metals exposure for insurance, not for emotional panic. It also means you watch the right indicators, not the loudest headlines. Watch net interest as a share of federal outlays. Watch the trend of Treasury auction demand. Watch bid to cover ratios. Watch tailing yields, meaning auctions clearing at higher yields than expected. Watch who is buying, domestic or foreign. Watch the growth of cross-border settlement rails that bypass the dollar, because these are the levers that determine whether erosion stays slow or accelerates. Now, I want you to think about your own behavior during the last major crisis. In 2008, the world didn't end. The market got crushed, then slowly recovered. Many people sold near the bottom because panic feels logical in the moment. Then they watched the recovery from the sidelines. This time the danger is different. This time the danger is erosion of purchasing power and financing conditions, not just a sudden crash. So the correct mindset isn't sell everything. It's stop assuming stability is permanent. And if you're still with me, Do this now. Click like because this video is exactly the kind of content that gets suppressed when the algorithm thinks people only want entertainment. That one click tells YouTube you want substance. Now let's finish by connecting the final dots. What does the end game look like in a modern collapse? And why the most dangerous part is that it feels normal until the day it doesn't. The end game of modern collapse is not a Hollywood apocalypse. It's a gradual decline in capacity, a world where borrowing gets more expensive, growth slows, politics becomes more hostile, and the standard of living erodes quietly year by year. It's not the end of America. It's the end of a specific arrangement. The arrangement where America could finance unlimited promises at ultra-low cost because the world had no practical choice but to fund it. That arrangement survives as long as three things remain true. Structural demand for dollars stays high, structural demand for treasuries stays deep, and confidence stays stable. China's digital currency expansion doesn't need to destroy those pillars directly. It just needs to offer enough bypass routes that structural demand weakens over time. And over time is all that matters when the debt stock is gigantic and rollover never stops. Here's the brutal truth. Empires don't fall when the debt becomes too big. They fall when the debt becomes inconvenient. For 75 years, lending to America was convenient, safest asset, most liquid, most trusted. No comparable alternative. Now convenience is eroding, not gone, eroding. And erosion is exactly how the ground disappears under your feet while you still feel like you're standing still. That's why the "don't sell yet" part of the title matters. The system can run longer than people expect. In fact, it usually does. The market can look calm while structural damage accumulates. That's why the disciplined approach is the only approach. Stay invested, but stay informed. Diversify, but don't detonate your plan. Focus on assets that produce value, not just assets that depend on stable currency conditions. And watch the math month by month, because that's where the real story is. If net interest costs accelerate faster than expected, that's your warning. If auctions start showing chronic weakness, that's your warning. If cross-border settlement rails grow into energy and commodities at scale, that's your warning. The collapse isn't a single day. The collapse is math playing out. And once the math breaks, it doesn't matter how confident people feel on television. Now, I want your take in the comments. Do you think the digital yuan is a real threat to dollar dominance, or is this overhyped? And what asset class do you think performs best in a world of higher rates and slower growth? Read the comments, reply to each other, keep it respectful. And if you want more deep breakdowns like this, subscribe because we cover the mechanics, not the noise.